Question 1. An investment advisor representative, IAR, moves from Firm A, a state-registered investment advisor, to Firm B, a federally covered investment advisor. Which of the following statements is true regarding the IAR's registration? A. The IAR must register with the SEC, and a duplicate filing must be made with the state administrator. B. The IAR must register with the SEC, and no state registration is required. C. The IAR's registration must be withdrawn by Firm A and refiled by Firm B with the state administrator. D. The IAR's registration with the state administrator transfers automatically from Firm A to Firm B. Answer: C. The IAR's registration must be withdrawn by Firm A and refiled by Firm B with the state administrator. When an investment advisor representative, IAR, terminates employment with an investment advisor, IA, both the IAR and the IA have a duty to notify the administrator promptly, typically through Form U5. If the IAR then joins a new IA, the new firm must register the IAR by filing a Form U4 with the appropriate regulatory authority, which in this case is the state administrator, because IARs always register at the state level, regardless of whether their firm is state or federally covered. This ensures proper oversight of the individual's activities and maintains an accurate record of their association. Remember, IARs are always registered at the state level, never with the SEC. Question 2. An investment advisor, IA, is required to disclose its fees to clients. Under the Uniform Securities Act, USA, which of the following best describes the timing of this disclosure for an IA that charges an annual advisory fee? A. The IA must disclose its fee schedule in writing to clients only upon request. B. The IA must disclose its fee schedule at least annually in its Form ADV Part 2A brochure. C. The IA must disclose its fee schedule in its initial advisory contract and annually thereafter. D. The IA must disclose its fee schedule to all prospective clients before entering into an advisory agreement. Answer: D. The IA must disclose its fee schedule to all prospective clients before entering into an advisory agreement. Under the Uniform Securities Act, USA, investment advisors have a fundamental obligation to provide prospective clients with a written disclosure document, often referred to as a brochure, which details the firm's services and fee schedule, among other things. This disclosure must occur at least 48 hours before entering into any advisory contract or at the time of entering the contract if the client has a right to terminate the contract without penalty within 5 business days. The core concept here is transparency and allowing clients to make informed decisions about the costs associated with advisory services before they commit. Always remember that full fee disclosure is a cornerstone of an investment advisor's fiduciary duty. Question 3. Which of the following economic indicators would generally suggest a period of economic expansion and increasing corporate profits? A. A decline in the Consumer Price Index, CPI, and a decrease in retail sales. B. An increase in gross domestic product, GDP, and a decline in unemployment rates. C. A rise in the federal funds rate and a decrease in housing starts. D. An increase in government bond yields and a decrease in consumer confidence. Answer: B. An increase in gross domestic product, GDP, and a decline in unemployment rates. Economic expansion is characterized by growth in overall economic activity, which is directly measured by an increase in gross domestic product, GDP. As the economy grows, businesses typically hire more workers, leading to a decline in unemployment rates. These two indicators, rising GDP and falling unemployment, are strong signals of a healthy, expanding economy where corporate profits are likely to improve. Think of it this way: more production and more people working usually mean more money circulating and higher earnings for companies. Question 4. An investment advisor representative, IAR, is evaluating a client's risk tolerance. The client states, "I cannot afford to lose any principal, as this money is for my child's college tuition in 2 years." This statement most directly indicates which of the following? A. A high capacity for risk and a short investment horizon. B. A low capacity for risk and a short investment horizon. C. A low capacity for risk and a long investment horizon. D. A high capacity for risk and a long investment horizon. Answer: B. A low capacity for risk and a short investment horizon. The client's inability to lose any principal signifies a very low capacity for risk, meaning they cannot tolerate significant fluctuations or potential losses in their investment capital. The phrase, "for my child's college tuition in 2 years," indicates a very short investment horizon, as the funds are needed soon. When capital preservation is paramount and the time frame is limited, an investment strategy must prioritize safety over growth, making this a classic example of low risk tolerance and a short-term need. Remember, capacity for risk relates to the financial ability to absorb losses, while willingness to take risk relates to an emotional comfort level. Question 5. A customer holds 100 shares of XYZ stock, currently trading at $50 per share. The customer wishes to protect against a significant price decline but also wants to participate in any potential upside. Which of the following option strategies would be most appropriate? A. Sell one XYZ call option with a strike price of $55. B. Buy one XYZ put option with a strike price of $45. C. Buy one XYZ call option with a strike price of $45. D. Sell one XYZ put option with a strike price of $45. Answer: B. Buy one XYZ put option with a strike price of $45. To protect against a significant price decline while retaining upside potential on shares owned, a customer should buy a put option. Buying a put option grants the holder the right to sell the underlying stock at the specified strike price, thereby establishing a floor for the stock's value. For example, buying a $45 put means the customer can sell their shares for at least $45, even if the market price falls further, while still benefiting if the stock price rises above $50. This strategy is known as a protective put, effectively ensuring the stock position. Question 6. All of the following are typically considered securities under the Uniform Securities Act, USA, except A. A variable annuity. B. A fixed annuity. C. An investment contract. D. A collateral trust certificate. Answer: B. A fixed annuity. Under the Uniform Securities Act, USA, a security generally involves an investment of money in a common enterprise with the expectation of profits to be derived primarily from the efforts of others. While variable annuities are considered securities because their value fluctuates based on the performance of underlying investment options, fixed annuities are not. Fixed annuities offer a guaranteed rate of return and principal protection, meaning the investor does not bear investment risk, the insurance company does. Therefore, a fixed annuity is primarily an insurance product, not a security. Question 7. Under the Uniform Securities Act, USA, which of the following persons is excluded from the definition of an agent when representing an issuer in certain transactions? A. An individual selling corporate bonds to institutional clients. B. An individual selling unregistered, non-exempt securities to the public. C. An individual selling an issuer's common stock in a public offering. D. An individual selling commercial paper with a maturity of 270 days or less. Answer: D. An individual selling commercial paper with a maturity of 270 days or less. The Uniform Securities Act, USA, provides specific exclusions from the definition of an agent when an individual represents an issuer in certain exempt transactions. One common exclusion applies to individuals who represent an issuer in effecting transactions in specific types of exempt securities, such as commercial paper that matures in 270 days or less and is sold in denominations of $50,000 or more. This exclusion recognizes that these transactions are typically limited to sophisticated investors and involve lower regulatory risk compared to broader public offerings. Remember that sales of exempt securities by an agent for an issuer often fall under an exclusion, while sales by an agent for a broker-dealer generally do not. Question 8. An investment advisor has entered into a soft dollar arrangement with a broker-dealer. According to Section 28(e) of the Securities Exchange Act of 1934, which of the following would be considered a permissible soft dollar benefit? A. Reimbursement for the investment advisor's office rent. B. Payment for the investment advisor's administrative staff salaries. C. Research reports and analytical software provided by the broker-dealer. D. Travel expenses for the investment advisor to attend a financial conference. Answer: C. Research reports and analytical software provided by the broker-dealer. Section 28(e) of the Securities Exchange Act of 1934 provides a safe harbor for investment advisors to pay a higher commission to a broker-dealer than another broker might charge, provided the advisor receives brokerage and research services that benefit the client accounts. Permissible soft dollar arrangements involve services that directly assist the investment advisor in making investment decisions for their clients, such as research reports, market data, and analytical software. Non-research related services like office rent, salaries, or travel expenses are not considered legitimate soft dollar benefits, as they do not directly aid in investment decision-making. The key is that the benefit must relate to the investment decision-making process. Question 9. A client is considering purchasing a municipal bond mutual fund. The client is in a high tax bracket and lives in the state where the municipal bonds and the fund were issued. The client is most likely interested in which of the following? A. Taxable income and capital appreciation. B. Tax-exempt income and diversification. C. High current yield and market liquidity. D. Inflation protection and capital preservation. Answer: B. Tax-exempt income and diversification. Municipal bonds generally provide interest income that is exempt from federal income tax. If the bonds are issued in the client's state of residence, the interest may also be exempt from state and local taxes, leading to what is known as triple tax-exempt income. Investing in a municipal bond mutual fund offers diversification across various municipal issues, which helps reduce the risk associated with investing in a single bond. This combination of tax-exempt income and diversification is highly attractive to investors in high tax brackets seeking to minimize their tax liability. Question 10. Under the Uniform Securities Act, USA, a consent to service of process, filed by an applicant for registration, appoints the administrator as the applicant's attorney for what purpose? A. To receive and process any civil lawsuits or subpoenas relating to the applicant's activities in that state. B. To approve or deny all investment recommendations made by the applicant to clients in that state. C. To act as a legal representative for the applicant in all criminal proceedings. D. To manage the applicant's investment accounts in the event of incapacitation. Answer: A. To receive and process any civil lawsuits or subpoenas relating to the applicant's activities in that state. A consent to service of process is a crucial legal document required for individuals and firms applying for registration under the Uniform Securities Act, USA. By filing this document, the applicant irrevocably appoints the state administrator as their legal agent for the purpose of receiving legal papers, such as subpoenas and civil complaints, on their behalf. This ensures that even if the registrant leaves the state, the administrator can still effectively serve legal documents to them regarding their activities within that state. It's an important mechanism for investor protection, ensuring that the administrator can enforce state securities laws. Question 11. Which of the following statements regarding the taxation of qualified dividends is correct? A. Qualified dividends are taxed at the investor's ordinary income tax rate. B. Qualified dividends are tax-exempt at the federal level. C. Qualified dividends are generally taxed at preferential long-term capital gains rates. D. Qualified dividends are subject to federal income tax only if they exceed a certain threshold. Answer: C. Qualified dividends are generally taxed at preferential long-term capital gains rates. Qualified dividends are a specific type of dividend payment that meets certain criteria set by the IRS, primarily related to the holding period of the stock. When these criteria are met, the dividends are taxed at a lower rate than ordinary income, typically at the same preferential rates applied to long-term capital gains. This favorable tax treatment is a significant benefit for investors receiving income from eligible stocks. It's worth remembering that this preferential rate incentivizes long-term investment in equities. Question 12. An investment advisor representative, IAR, is determining the appropriate asset allocation for a client. The client is 30 years old, has a high-paying job, and plans to retire at age 65. The client also indicates a willingness to take on moderate risk for higher potential returns. Which of the following asset allocations would generally be most suitable? A. 70% bonds, 20% stocks, 10% cash. B. 50% bonds, 40% stocks, 10% cash. C. 70% stocks, 20% bonds, 10% cash. D. 90% cash, 10% stocks. Answer: C. 70% stocks, 20% bonds, 10% cash. A 30-year-old client with a long investment horizon, 35 years until retirement, and a willingness to take moderate risk for higher potential returns is generally suited for a portfolio with a higher allocation to equities. Stocks, while more volatile in the short term, historically offer the best potential for long-term growth and outperforming inflation. Bonds provide stability and income, while cash offers liquidity. A 70% stock allocation aligns with the client's long time horizon and stated risk tolerance, allowing ample time to recover from market downturns and benefit from long-term equity appreciation. Question 13. All of the following are powers of the state administrator under the Uniform Securities Act, USA, except A. To issue cease and desist orders without a prior hearing. B. To require registration of securities, agents, and investment advisors. C. To retroactively amend the USA to apply to past transactions. D. To conduct investigations and subpoena witnesses. Answer: C. To retroactively amend the USA to apply to past transactions. The state administrator has broad powers under the Uniform Securities Act, USA, to protect investors and enforce state securities laws. These powers include issuing cease and desist orders, requiring registration, conducting investigations, and administering oaths. However, the administrator does not have the authority to retroactively amend the USA. Laws and regulations are generally applied prospectively, meaning they govern future actions, not past ones, to ensure fairness and due process. This is a fundamental principle of legal systems designed to prevent arbitrary enforcement. Question 14. Which of the following best describes the primary goal of the Investment Advisors Act of 1940? A. To regulate the trading of securities on national exchanges. B. To ensure the solvency of investment advisory firms. C. To regulate investment advisors by establishing registration and ethical standards. D. To oversee the issuance of new securities by corporations. Answer: C. To regulate investment advisors by establishing registration and ethical standards. The Investment Advisors Act of 1940 is a federal law specifically designed to regulate the activities of investment advisors, IAs. Its primary goal is to protect investors by establishing a framework for the registration of IAs with the SEC, for federally covered IAs, and setting forth ethical standards, disclosure requirements, and prohibitions against fraudulent practices. The Act aims to ensure that investment advisors operate transparently and act in the best interests of their clients, fulfilling their fiduciary duty. This Act is crucial for defining who an IA is and how they must conduct business. Question 15. A client inherits a substantial sum of money and wants to establish a trust for their minor grandchildren. The client wants to retain the ability to change the beneficiaries and terms of the trust during their lifetime. Which type of trust would be most appropriate? A. Irrevocable trust. B. Testamentary trust. C. Revocable trust. D. Charitable remainder trust. Answer: C. Revocable trust. A revocable trust, also known as a living trust, is a legal arrangement that allows the grantor, the person who creates the trust, to retain control over the assets placed in the trust during their lifetime. The key feature of a revocable trust is its flexibility. The grantor can modify, amend, or even terminate the trust at any time before their death. This ability to change beneficiaries or terms perfectly aligns with the client's desire to retain control and flexibility regarding the assets for their grandchildren. In contrast, an irrevocable trust generally cannot be changed once established. Question 16. A security that represents an undivided interest in a fixed portfolio of specified securities, with a termination date, is known as A. Mutual fund. B. Exchange-traded fund, ETF. C. Unit investment trust, UIT. D. Real estate investment trust, REIT. Answer: C. Unit investment trust, UIT. A unit investment trust, UIT, is a type of investment company that issues redeemable shares representing an undivided interest in a fixed portfolio of securities. Unlike mutual funds, a UIT's portfolio is generally static and not actively managed. The trust typically has a specified termination date, at which point the securities are liquidated, and the proceeds are distributed to unit holders. This structure provides investors with diversification and professional selection of securities without ongoing management fees, making it distinct from actively managed funds like mutual funds or ETFs. Question 17. Which of the following is an example of an asset that would typically be included in a client's net worth calculation? A. Annual salary. B. Mortgage balance. C. Home equity. D. Monthly rent payment. Answer: C. Home equity. Net worth is a measure of an individual's financial health, calculated as the difference between their total assets and total liabilities. Assets are what a person owns, while liabilities are what they owe. Home equity, which is the current market value of a home minus any outstanding mortgage debt, represents an asset that contributes to net worth. Annual salary is income, a mortgage balance is a liability, and a monthly rent payment is an expense. None of these directly represent an owned asset. Question 18. An investment advisor, IA, has discretion over a client's account. This means the IA can make decisions regarding A. The timing of trades only. B. The asset amount and type of security only. C. The price and timing of trades only. D. The asset, amount, and price or timing of trades. Answer: D. The asset, amount, and price or timing of trades. When an investment advisor, IA, has full discretion over a client's account, it means they have been granted the authority to make decisions regarding the 3 A's, asset, amount, and action, which includes price and timing. The IA can decide what security to buy or sell, asset, how much of that security to buy or sell, amount, and when or at what price to execute the transaction, price or timing. This broad authority requires the IA to always act in the client's best interest, adhering to their fiduciary duty. Question 19. Under the Uniform Securities Act, USA, the term guaranteed, when used in relation to a security, means that the security's principal, interest, or dividends are guaranteed by A. A bank or other financial institution. B. A government agency or instrumentality. C. A person other than the issuer. D. The issuer itself. Answer: C. A person other than the issuer. Under the Uniform Securities Act, USA, the term guaranteed has a very specific meaning when used to describe a security. It signifies that the payment of principal, interest, or dividends is guaranteed by a third party, which is someone other than the issuer of the security. This is an important distinction because it implies an additional layer of financial backing beyond the issuer's own promise to pay. For instance, if a bond is guaranteed, it means a separate entity has pledged to make payments if the issuer defaults. Question 20. Which of the following financial metrics is most commonly used to measure a company's profitability and efficiency in generating earnings for its shareholders? A. Debt-to-equity ratio. B. Price-to-earnings, PE, ratio. C. Earnings per share, EPS. D. Current ratio. Answer, C. Earnings per share, EPS. Earnings per share, EPS, is a widely used financial metric that indicates how much net income a company generates for each outstanding share of common stock. It is calculated by dividing a company's net income, minus preferred dividends, by the number of outstanding common shares. A higher EPS generally indicates greater profitability and efficiency in generating earnings for shareholders, making it a key indicator for investors evaluating a company's financial performance. While other ratios are important, EPS directly reflects the earnings available to each share. Question 21. An investment advisor representative, IAR, is explaining the risks of variable annuities to a client. Which of the following is a primary risk associated with variable annuities? A. Interest rate risk, as the fixed interest rate may not keep pace with inflation. B. Investment risk, as the value of the separate account can fluctuate based on market performance. C. Default risk, as the insurance company may fail to make guaranteed payments. D. Inflation risk, as the purchasing power of the fixed payments decreases over time. Answer, B. Investment risk, as the value of the separate account can fluctuate based on market performance. Variable annuities are distinct from fixed annuities because the investor bears the investment risk. The contract holder's funds are invested in a separate account, which consists of various subaccounts that are essentially mutual funds. The value of these subaccounts, and therefore the value of the annuity, can fluctuate significantly with market performance. This means that if the underlying investments perform poorly, the annuitant could lose principal and receive lower payments during the payout phase. This direct exposure to market performance is the primary investment risk. Question 22. A client is considering purchasing shares of a publicly traded limited partnership. Which of the following would be considered a major risk associated with investing in limited partnerships? A. High liquidity due to active trading on major exchanges. B. Unlimited liability for limited partners. C. Lack of control over management decisions for limited partners. D. Preferential tax treatment at the corporate level. Answer, C. Lack of control over management decisions for limited partners. In a limited partnership, limited partners contribute capital but typically have no involvement in the day-to-day management or control of the partnership's business activities. This lack of control is a major risk, as limited partners rely entirely on the general partner to manage the business effectively and make sound decisions. While limited partners enjoy limited liability, only to the extent of their investment, their inability to influence operations can be a significant drawback. This lack of control often necessitates a high degree of trust in the general partner. Question 23. An investment advisor is calculating the present value of a future cash flow. Which of the following concepts is most directly applied in this calculation? A. Compounding. B. Diversification. C. Discounting. D. Capitalization. Answer, C. Discounting. Calculating the present value of a future cash flow involves discounting, which is the process of determining the current value of a future sum of money or stream of cash flows, given a specified rate of return. Essentially, it reverses the concept of compounding, taking future dollars and translating them into today's equivalent value by considering the time value of money. This calculation is crucial for valuation, as it helps determine what a future payment is worth in today's terms. Question 24. A client is concerned about inflation eroding the purchasing power of their fixed income investments. Which of the following investments is specifically designed to provide protection against inflation? A. Corporate bond. B. Treasury inflation protected security, TIPS. C. Preferred stock. D. Municipal bond. Answer: B. Treasury inflation protected security, TIPS. Treasury inflation protected securities, TIPS, are a type of U.S. Treasury bond specifically designed to protect investors from inflation. The principal value of a TIPS bond adjusts semi-annually based on changes in the Consumer Price Index, CPI, which is a common measure of inflation. As the CPI rises, the principal value of the TIPS increases, and the interest payments, which are a fixed percentage of the adjusted principal, also increase, effectively preserving the purchasing power of the investment. This direct linkage to inflation makes TIPS a unique tool for inflation protection. Question 25. An investment advisor must adhere to the brochure rule as required by the Investment Advisors Act of 1940. This rule generally mandates that the investment advisor must provide a written disclosure document to clients. A. Only upon written request from the client. B. At least annually to all existing clients. C. Prior to or at the time of entering into an advisory contract. D. Within 30 days of opening a new account. Answer: C. Prior to or at the time of entering into an advisory contract. The brochure rule, primarily found in Rule 204-3 under the Investment Advisors Act of 1940, requires investment advisors to deliver a written disclosure document, the brochure, typically Form ADV Part 2A and 2B, to prospective clients. This must be done either at least 48 hours before entering into an advisory contract or at the time of entering the contract, provided the client has a right to terminate the contract without penalty within 5 business days. The purpose is to ensure that clients receive comprehensive information about the advisor's services, fees, and business practices before they commit to an advisory relationship. This upfront disclosure is fundamental to transparency and client protection.